Gold miners are in really poor shape. They've been beaten quite a lot over the last couple of weeks. Are they getting ready to turn back up though? Let's talk about that. Welcome to myfinancesteacher.org, where all of my trades are transparent to the members through this model portfolio, which looks something like this, where we split our portfolio into 4 quarters: crypto, general stock market, precious metals, and energy. And at the bottom right corner, we see an example of how the model portfolio lists all of the trades that I've ever done since the start of the portfolio in the first half of 2020. Now, coming back to the performance of precious metals, as usual, let's start with the dollar index first. So here's the dollar index in front of us, and it seems to me that the previous cycle in the dollar, which started over here at the end of July, did actually finish in early September, lasting for only 35 days. It's very unusual. Usually, at least between late 2018 and mid 2020, these dollar cycles on average lasted for around a couple of months. But of course, sometimes they stretch, meaning that to keep the average at around a couple of months, sometimes these cycles are pretty short. So I think the chances are pretty good. Perhaps there is a 60% chance that we are now in a new dollar cycle that so far has been going on for only 25 days, meaning that perhaps it has another few days higher to give us another poke above the Bollinger Bands. And as I've mentioned many times in my previous videos, repeated pokes above a relatively wide Bollinger Bands, and they're not very narrow over here, often comes before some sort of a reversal. So in this case, that would be a reversal to the downside. So that is a 60% chance scenario. There is another scenario with a, say, 40% chance or so that the daily cycle in the dollar that began in late July is still ongoing, and it's going on for 60 days now, meaning that it's already close to its average duration, meaning that a sharp fall in the dollar index might actually happen over the next 1 or 2 to 3 weeks, giving us significant decline, perhaps into a bit of a lower low on the dollar index. I don't think it's very likely, perhaps only around a 35 to 40% chance of this scenario. I think it's more likely that dollar continues higher for another few days and then gradually grinds lower for another several weeks, giving us a cycle that lasts some sort of an average duration of around a couple of months. And in whichever scenario we are regarding the short-term daily cycles, the intermediate cycle in the US dollar is at 126 days already. And usually these dollar cycles last for somewhere around half a year, sometimes a bit longer, sometimes a bit shorter than that. The couple of previous cycles were much shorter than usual, meaning that if the average duration is maintained, perhaps this cycle will be longer than usual, longer than half a year. So perhaps there are another couple of short-term daily cycles in the ongoing intermediate cycle in the US dollar, which would perhaps give you one more relatively modest bounce in the US dollar, perhaps another couple of weeks from now before one last drop into that intermediate cycle low. But for the time being, over the next few days, perhaps a bit more weakness in gold before a rally into the new daily cycle. But we'll have a look at gold in a moment. Before that, let's have a look at the 10-year rates, which are right now into the resistance zone anywhere between 1.44 into 1.54. And despite this resistance zone, I think there is perhaps a 60% chance that the rates continue a bit higher for a short while before coming down to retest this 200-day moving average, perhaps a bit of a bounce from that support of the 200-day moving average, giving you some sort of a head and shoulders formation and a drop perhaps to the lower range of the Bollinger Bands. After all, perhaps in 1 or 2 weeks, this 14-day RSI would enter into overbought territory, and perhaps there will be a need for some sort of a cool down in the rates. And by the way, this support resistance zone is perhaps somewhat important, going back all the way back to late 2019. As we see, this support resistance zone 1.44, 1.54 has been hit and bounced from multiple times during this couple of years. And while we're looking at this longer term chart, you might notice something resembling a cup and handle formation. So for that reason, going further into the future, perhaps into late this year, early next year, there might be significant strength in the rates. Perhaps something similar to what happened with this cup and handle formation in 2016, 2017. After that, we see rates significantly higher, from a low of 2% to a high of 3.1%. Is that going to be detrimental for gold? Is that going to be painful for gold? Well, in addition to the rates themselves, that will also depend on inflation. If rates are rising due to higher inflation expectations, then gold might rise on that as well. But for the time being, we don't see much inflation expectations. The markets are not really scared of inflation right now. So this negative correlation between gold and these 10-year rates perhaps is going to be maintained at least over the next couple of months. So again, in the very short term, perhaps another few days, a bit of a painful time in the precious metals before a bounce into the new short-term daily cycle while rates cool off a little bit. And lastly, looking at the technicals on these rates, there might be a bit of a ascending triangle over here. Looks like rates have broken out of this triangle, and the usual measured target is the height of the triangle, bringing that target of rates topping out perhaps relatively soon, somewhere around that 1.6%, maybe a bit higher than that. So to summarize our view of the US dollar and rates, it looks like there might be a bit of a pain for gold in the very short term before a bounce into the new short-term daily cycle, and that actually does agree with the gold chart. Last time we had a look at gold, we said that gold is likely to drop into the short-term daily cycle. That's exactly what gold has done over the last couple of weeks. And perhaps there was a daily cycle low over here on the 23rd of September, giving us a cycle 45 days long, which is very close to a usual duration. But as dollar and the rates tell me, perhaps there is a bit more pain in the precious metals. Perhaps gold still has another few days down, giving us perhaps a little bit of a lower low into the short-term daily cycle low, lasting closer to the average duration of around 2 months. And that's when gold will be ready to bounce into the next short-term daily cycle of this new ongoing intermediate cycle. So perhaps this new ongoing intermediate cycle might look something like the previous cycle, where we see cycle starting with a bit of a rally in gold into the first half of March and a retest of those lows shortly after the beginning of that cycle. So we see something similar developing over here, the new cycle starting into late August, and gold is brought back down close to retesting these recent lows, if you ignore this the long red wick on this candle on 9th of August. So what it means is this cycle is perhaps going to be kind of a nothing cycle, kind of a meh cycle, where gold doesn't really create any explosive moves, because after all, the cycle has already been going on for nearly a couple of months and we don't see any gains in gold. And if the intermediate cycles usually top 3 to 4 months into the cycle, we don't have that much time left before we see some sort of a top in gold. So perhaps in the next cycle, gold might come close to some resistance zone somewhere around 1900, maybe a bit lower than that, 1880, before coming down into a short-term daily cycle low again, which usually lasts for a couple of months. Then another last push higher into a very modest rally, into a very weak rally of the last daily cycle of the ongoing intermediate cycle, and a drop into that intermediate cycle low, perhaps somewhere around into early next year. And that's when Chinese New Year comes up, which usually is the time when gold is relatively strong. So that aligns well with a rally into the new intermediate cycle. And lastly, zooming in a little bit, if gold continues down for another few days, that will give us a third repeated poke below widening Bollinger Bands, again, which usually indicates some sort of a reversal. So there is that agreement on the short-term technicals as well. Next, let's have a look at GDX. It's quite painful what has been happening to GDX over the last several weeks. Miners are actually underperforming gold itself quite significantly. But at the moment, as you see, miners are quite a bit below the 200-day moving average. GDX is right now 15% below its 200-day moving average. At the previous intermediate cycle low, it came down to around 18% below its 200-day moving average. So perhaps a bit of a bounce is coming up in gold miners. And looking at the intermediate cycle low before the previous one, Yes, GDX came down all the way down to 40% below its 200-day moving average. But, well, that was the time when everything crashed quite significantly into that pandemic of March 2020. So, in my opinion, miners are quite oversold, and I don't really want to get out of my positions. Unfortunately, I've been holding full positions in precious metals for a while already. I've actually talked about that in one of my previous videos on gold miners, so you can have a look at that. And in that video, I also mentioned that if GDX breaks this long-term support somewhere around $30 to $31, there would be a risk of GDX coming down to at least fill this gap somewhere around $26.50. And if that happens over the next 1 or 2 weeks, perhaps I will temporarily break my rule and go beyond a quarter of portfolio allocation to precious metals, as at about $26, GDX would be quite oversold. Next, let's move on to the optimism index in gold. We see that these intermediate cycles in gold, which I marked with these vertical red lines, do align with some sort of a low on the optimism index. That's when the markets are generally quite pessimistic on precious metals. Remember, you want to enter the markets when there is this proverbial blood on the streets, when nobody wants to hold this asset. And when optimism has rallied quite a bit, that's when you probably want to reduce your allocation. So far within the ongoing intermediate cycle, the optimism hasn't really improved very much. So I still expect one more push higher before that drop into the intermediate cycle low. Perhaps this push higher, though, as I mentioned, is going to be quite modest. So I will try to take profits on the positions without waiting for any kind of outsized gains. And lastly, let's have a look at the optimism index on GDX, where I included this solid green line, the 10-day moving average of this optimism index, because it's quite volatile. And I added this horizontal red line at the bottom of the chart, somewhere around the level of 30. We see that every time this 10-day moving average of the GDX optimism hits that level of 30, we see at least a short-term bounce in GDX. And right now, this green line, this 10-day moving average is around 32. So perhaps, as I mentioned, another couple of days down for GDX to allow this 10-day moving average of the optimism to come to that level of 30 before that bounce into the next short-term daily cycle. So that's my view on precious metals. But while precious metals are relatively weak right now, there are a lot of other assets to take advantage of. As you see, I do update the members at myfinancesteacher.org on a range of assets quite regularly. So you are more than welcome to join us. But even before that, remember to hit that like button, share this video with your friends, and tell me, what do you think on the possibility of GDX filling this gap at around $26.50 over the next 1 or 2 weeks? Is GDX going to fill that gap before bouncing into the new cycle, or is it not going to drop that low? Share your opinion in the comments below. Have a pleasant day and good luck in your trades.